Hello, everyone. David from Mortgage Choice. It's Tuesday, the 10th of December, and the Reserve Bank announced this afternoon that interest rates would remain the same. Current cash rate sitting at 4.35%. So no change, unfortunately, before Christmas, and this was expected. It was going to be unlikely for the Reserve Bank to decrease interest rates prior to the busiest spending period of the year. That would only have further encouraged additional spending and potentially more harm to inflation. So unfortunately, no early Christmas present from the Reserve Bank. But let's get into the announcement and see if we can work out where we might see rates coming down or when we might see rates coming down. All right, so the main issue that the Reserve Bank continues to beat on about is this issue with underlying inflation. And currently, it's sitting at 3.5%. Their target for this is between 2 and 3%, so we're not far off. But what they're now saying is that they want to see it at 2.5%. So the midpoint is their target range for this underlying inflation. And the expectation right now, the way things are going with the economy and inflation, is that we won't see that hitting until about the early part of 2026. Now, that doesn't mean that we're going to wait until 2026 to see rates drop. It just means that underlying inflation is still a massive issue for the RBA. And unless they see a great downturn in the economy, then it's likely we'll see an extended period of time where rates remain as they are. So cash rate, this lovely red line that we've been talking about for the last 3 or 4 years, we can see where rates were back prior to the financial crisis. They were expected to go up to 12 or 13%. The financial crisis hits in America and the US, America and Europe, and interest rates came down quite fast. Interest rates went back up as the economy in Australia picked up with the mining boom. And then as China slowed their spending, we saw interest rates dropping for about 10 years in a row. They dropped and dropped and dropped. And it wasn't until we got to the COVID period. We can see here with COVID, interest rates were at an all-time low. And then they ramped up quite heavily with the issues around inflation and all of the government stimulus that we had or needed during COVID. And that's where it's left us here, this flat bar here at 4.35%. Now, before we go on to the other news, let's slide over quickly to the ASX website. I really like this website. It's giving you an idea of where the market expects interest rates to go. This dotted blue line going across the screen is the current cash rate at 4.35%. And then you can see these predictions down here. So as of, let's say, June of 2025, the expectation is that the cash rate would have dropped by 0.4. Now, this isn't a guarantee. This is just a crystal ball prediction that the market expects based on all the different parameters floating around. I like looking at this because the market, they're trying to make money and they're trying to hedge their bets on where the market will go. And they're normally pretty good about it. So the expectation is that we'll likely see at least one cash drop, rate drop by April. And if we look further down to say January of 2026, so just over a year away, we're almost 1 full percent down on where we're at now. And to give you an idea of a rate decrease and what it might mean for your mortgage, obviously we've seen interest rates going up. If they start to come down, every 0.25% drop on a $500,000 mortgage, it roughly equates to about $100 per month that you'll save. So if we're saving a full 1%, that's $400 extra a month in your pocket, or almost $5,000 a year in your pocket. So a massive, massive difference as we hopefully start to see interest rates coming down in the coming months. Now, in the news, we had an article in the Australian, and it was quoting Shane Oliver from AMP, which I really like. I think Shane's a pretty good predictor of what's going on. And what he was saying is that the RBA is concerned about the weakness in productivity, which causes issues with inflation, but that the weaker expected GDP growth shows that the economy is not picking up as quickly as they expected. So the RBA is likely to downgrade the growth expectations for the economy, which should lessen concerns about excess demand or further increases in inflation. So in the end, yes, we've got an issue with inflation, but because the economy is slowing down due to the high interest rates that we've experienced, hopefully those two things will balance each other out and we'll start to see some rates coming down. Right now, I believe it's Commonwealth Bank that's expecting rates to drop in February, so in a couple of months' time. The other major lenders are expecting that we won't see a rate drop until May. All right, so we'll see how that goes. Now, for first home buyers, I think in the last 12 months, with all of the different government benefits that are available, it's quite a great time for first home buyers, but it's also quite confusing because there's so many different areas that you could benefit from and so many different options that you can consider. And that gets further complicated when we look at the lender options and what lenders offer the certain government schemes that you might benefit from. So the best recommendation I can get for first home buyers, number one, schedule a meeting with us as soon as possible. And number two, take the time to get pre-approval. Pre-approval allows the bank to assess you as a borrower and confirm that they're happy to lend you money so that before you go out and start making offers and getting emotionally attached to a property, you know that you're good to go and you've got the bank's sign off. All right. Now, for upgraders and investors, I might quickly slide over and just show you some of the tools that we use for upgraders and investors during the meetings that we have one-on-one with clients. Now, for upgraders, and I might just slide over to this tool here first. For upgraders, what we're looking to do is work out how much you're going to get out of the sale and how much you'll have to put towards the purchase. So in this example, let's assume that you've got a property worth $800,000. And we've got selling costs based on that sale price of about $21,000. And that includes a 2% commission for the agent, $3,000 for marketing, $2,000 for conveyancing. So we want to try and factor in all the costs involved in both the sale and the purchase. We've got about $350,000 in home loans to clear in this example. And the client wants to keep $20,000 cash set aside after the settlement on the purchase, just so they've got a savings buffer. So that leaves us with $409,000 to go towards the purchase, and that carries over into this calculation here. All right, so we can see in this example, we've got a purchase price of $1.4 million. We've got total cost to include stamp duty, transfers, and legals of about $82,000. Minus the 409 in contributions or sales proceeds, and that leaves us with a loan of just over $1 million. All right. Monthly repayment on that at 6%, you're looking at $6,433, and an LVR of 76.64%. So we can see, no, you don't have to pay lender's mortgage insurance. That's great. We're under 80%, so no lender's mortgage insurance. Bridging loans are possible in this situation, and I'll cover off on bridging loans here in just a second. And also the cost to move. We want clients to realize how much it's costing them to move from one house to the next to ensure that they're getting enough benefit from that cost. You know, if you're going from an $800,000 home to an $850,000 home, I'll just put in $850 here. It's costing you $72,000 to get an extra $50,000 of value from that property. Now, that might be justified because maybe you're moving from the city to the country. But if you're moving from one suburb to the neighboring suburb, is that giving you enough benefit to justify that cost? And that's part of the discussion that we have with our clients. Now, this is the number side. We then need to work on how we actually physically relocate you from one house to the next, and in what order do we do that? And there are three main areas that we take our clients through, or three main options. We've got a simultaneous settlement where you're settling on the same day for both the sale and the purchase. Quite complicated, but this is what most people do. 95% of people will do a simultaneous settlement. Bridging loans are becoming more and more popular now that people aren't keeping their existing home as an investment. They're having to sell to get the best benefit for their purchase. So bridging finance is becoming more and more popular. It's expensive, but it's also the most convenient. Or the last option, and not many people do this, but selling before you purchase and then organizing a place to live. So these three options, I'm not going to spend too much time now going through them, but this is part of the discussion that we have with our clients. It's not just about setting up the numbers and making sure that the loan works. How do we actually physically relocate you from one house to the other? In what order do we need to do everything? And how can we make that as easy and as seamless as possible? All right. The last thing that I'll cover off on is for investors. If we have, let's say, I'll just clear these out quickly. Let's say that you've got an existing home and it's worth $900,000 and you've got a loan of $450,000 against that property. And we can see here you've got a total loan to value ratio of 50%. And we're trying to use equity in this existing home to help us with this investment purchase. And if this investment purchase is $500,000, we know that it's actually going to cost about $530,000. upfront costs for a Victorian property are usually about 6% of the purchase price. So I'll assume about 30,000 there. But we can't borrow 530,000 against this house because we're trying to borrow 106% loan to value, and the bank won't allow that. So we need to reduce this loan down to 80%, which is 400,000. And the remaining debt, that extra 130 that we need to complete the purchase, that gets borrowed against the existing home. And that is how we use equity in an existing home to help us with an investment purchase. You're still borrowing $530,000. We're just spreading the debt across two properties to make the bank happy, help you avoid mortgage insurance, and help you avoid cross-securing. All right, so these are some of the details and some of the tools that we'll use when we discuss whether you're looking to upgrade or buy an investment property. I think that going through these spreadsheets and providing a visual representation of what a client's getting into, it helps better understand or helps better sink in what they're looking to do. All right. So current interest rates sitting at 5.90 for owner occupied and 6.20 for investment. We continue to do client reviews for everyone as well. Every 6 to 12 months, you should be getting a phone call from us to review your existing mortgage. If you haven't heard from us, please reach out to us and we'll do a review straight away for you to make sure that your rate remains competitive. But you should be looking at rates roughly in these areas if you're looking at refinancing to a new bank. All right. Thank you again for your time. I hope everyone has had a great year, and I hope you have some time off over the holidays to enjoy with your friends and your family. And we'll no doubt speak in the new year again when we hear from the Reserve Bank. Now, as far as schedules go, I'm available for appointments. I've got a few slots available still before Christmas, and I've got times available early January. So if you've got ideas that you're thinking about for next year, whether it's upgrading or buying an investment or buying your first house or buying a car, whatever it might be, reach out, get an appointment booked in, and happy to have a chat. Thanks for your time.